Greetings and hello, my YouTube family. Thank you so much for visiting my channel, and I would like to encourage you to click subscribe so that you don't miss content like this in the future. So, today I would like to talk about different types of investing, namely passive and active investing. But before I get into the details of those types of investing, I just want to make sure that you understand that the content and the views that I share here, they are just for educational purposes. Investing is a risk, so it is important that you do your own due diligence before you invest your money. Now, under passive investing, one popular thing that people who follow that particular investing strategy do is they just understand that they don't want to spend a lot of their time worrying about uh, what's happening in the market over the short term. So, passive investing, as an example, involves putting your money in index funds or exchange traded funds, commonly known as ETFs. And an index fund is basically um, a situation where investors pool their money together, and then that money then invested in different securities that include stocks, bonds, or whatever assets classes that the fund manager can choose to do. And examples of index funds, for example, the common ones, the popular ones, is the Dow Jones Index, which is the um, uh, historically one of the oldest ones. Basically, it tracks the top industrial companies. So, but it changes over time. For example, the top 30 industrials in the United States, it's called the Dow 30. Basically, it includes companies like Microsoft, Home Depot, and it's a whole list of those companies, and they automatically track those companies. And in that case, like the Dow 30 is 30 companies. And one of the other popular ones is the S&P 500 that is managed by the SPDR Trust. Basically, it tracks the top uh, like 503 companies or businesses that are publicly listed in the United States. So, what it means is that if you have a share for the SP 500 and it has a ticker name of SPY, what it means is that you will have uh, uh, it constitutes 503 companies, and the shares they are weighted depending on what the trust decides. For example, you find out that the top three stocks that are in that particular index, the SP uh, uh, 500, is Apple, which is 7%, and Microsoft, right? They both have 7%. And then you also have Amazon, you also have Nvidia. So it's a whole list of those industries that cuts across different sectors. So it basically tracks the performance of those stocks, and the shares they are weighted in those percentages that the fund managers decide. And basically, it is very little or low cost. So what it means is you don't have to worry about is the market up or down today. If you put your money, it means it just tracks those companies. And if there are companies that don't perform well, the trust will then decide to take those out. So you don't necessarily have to worry about those. And then actively traded funds, basically they are somewhat similar to index funds, but the difference is that some of them they're actually actively managed in that the fund manager for that portfolio can actually buy or sell stocks in the open market. So there are a lot of them actually. So you just have to think of it as a way of just investing in those broadly diversified stocks. Now, what then happens is that a lot of people, a lot of fund managers, you're talking of bankers and other investors, they don't actually beat the S&P 500, a lot of the index funds. In other words, If you look at the research between 2010 actually and 2021, 87% of the fund managers in the United States, they didn't beat the S&P 500, or the index funds. So what it means, if you invest in the index funds, let's say the S&P 500 is an example, you are actually going to beat 87% of the fund managers without doing much other than just investing your money or depositing your money regularly. And over the past 30 years, the S&P 500 has returned approximately 10%. And what this means, that is on average, it means in some years it goes up somewhat more than 10%, and in some years it goes down. And especially in years where there are bear markets, and on average, if you look at the United States Stock Exchange or the stock market in general, every other 4 years historically there has been bear markets. In other words, the major indices, they dropped by at least 20%. So what it means is that in some years it drops and in some years it goes up. So on average, if you average it out, you get 10%. But as a long-term investor, when the market drops, major indices or the market drops uh, uh, down, it means it's a huge opportunity to buy good businesses at a huge discount. And on the other hand, you find that under active management, some people may choose to decide, to invest in individual stocks. So there are a lot of them, and one key challenge is that some people, they say, "How do I pick out a stock out of, let's say, the 2,500 that are listed? Yeah, let's say in the New York Stock Exchange." And there are a lot of options. For me, I just look at it in a very simplified way. I first of all think of what are the services that I use every day. For example, if I want to buy something online, I just think of Amazon, right? As an example. Right now I'm recording on a desktop, on a computer. It uses Microsoft products like Word documents, Microsoft Word, and all the other parts, components of the software. But beyond that, because if you invest in individual businesses and you want to actively manage your portfolio, what it means is that if one individual stocks declares bankrupt, in other words, it fails completely, it means you lose all your money. So in if you invest passively in an index fund like S&P 500, it means those 503 companies, as it is constituted uh, as of yesterday, it means that even if one stock goes bankrupt, the other that remain, they will still be able to give you some return. So it's a diversified portfolio. On the other hand, if you invest in individual stocks, it means you have a chance that you can lose all the money. But however, if you decide to go that route, some people, like for me, what I like to do is I don't want to invest more than 5% of my total portfolio in one stock, no matter how confident I am. But before I even do that, I have to do my own research, and I look at the four criteria. The first thing that I look at is what is the service that this business provides. For example, I gave you an example of Microsoft. Or some people think of Tesla, they produce cars, but it also has an artificial intelligence data. Artificial intelligence component. So you really have to understand. So for me, I stick to things that I understand, that are very easy to understand. Secondly, I like to invest in companies that have a huge moat. In other words, they have a competitive advantage. They can increase or change their prices without necessarily losing the market share. So I look at those things, and then I look at the management. Who are the people who are at the helm of of this company or this business? If you look at Apple, you think of the CEO, right? And you look at their track record, right? And under the management type, I like to look at other matrices, sub matrices that include Are they managing the finances well? In other words, I look at the financial statements, and this is publicly available information. So I look at the track record. I like to look at their debt, long-term debt in particular, which is in the balance sheet or the statement of financial position. And then I also like to look at the free cash flows. In other words, the money that is coming in. So that information you can find it on the cash flows, right? So if the free cash flows, right, it shows that it is increasing or it has been increasing over time. That's the trend that I want to look at, right? Versus the debt. And I don't want to invest in a company that will not be able to pay off their debt uh, in 3 years at most. In other words, the free cash flows, that number, if you divide it for that year, if you do the ratio or if you take the ratio of that free cash flows for that year, is and you uh, put it into the long-term debt for that year, right? It should not exceed 3. In other words, it should be paid off, let's say, in 3 years. So you find that if it is a huge debt and there are other external or macroeconomic situations that happen, for example, the Federal Reserve Bank increases the interest rates to curtail inflation, like they've been doing all over the world, including in Canada or other advanced economies like the United States, right? Sometimes investors freak out and they panic and then they sell. So if a company is debt that is settling, is an albatross on the neck. So what it means is some businesses may actually fail. So I just want to stay out of businesses that have a lot of debt, in short. And then I also like to understand the intrinsic value of the business. This is very, very important because a lot of people they lose money because businesses or the stock price it follows a random walk. In other words, it fluctuates, it goes up and down, right? So what it means is that sometimes it goes above the intrinsic or the average intrinsic value, right? So if you buy when it's at the top, it means when it reverts or goes down to the average, it means you lose some money, right? So if you're investing, the idea is as simple as buying price, right? You subtract the selling price minus the buying price. In short, that's the symbol. So you have to buy when it's low. In other words, if it is discounted, it is below the intrinsic value, and sell when it's high. So when you buy stocks, the expectation is that over the long term, it's going to increase in value, the share value as reflected by the stock price. So um, that's what I look at in short. So in summary, when I'm investing in individual stocks, I like to invest in businesses that I understand in terms of the services that they provide to the public, right? And then two, I want a business that is a competitive advantage. Number three, I want to invest in business that is management who have a good track record. I want to know their background. I don't want to invest in businesses that are managed by people who don't understand how to manage the finances of the business, that don't understand or that fail to produce a good return on equity. In other words, I look at the ROE, return on equity. It has to be at least 15%. In other words, when I invest my money, I want to get at least 15% return. And there are a lot of businesses that retain those kind of returns annually. So I look at the trend over the past 5 years, what has been their track record. And lastly, but not least, it has to be undervalued at that particular time. So what it means is I do my research where I have the time. I look at the all the things that I have mentioned, and then I estimate using various models like discounted uh, uh, cash flow model or price earnings, and most of this information is publicly available. And then what I then do is I then just wait for the business to be undervalued. In other words, to fall below the intrinsic value, so that if it fluctuates, right, I will still not lose my money, right? So, in other words, let's say I want to invest $10,000 in one stock. I can then say, well, if it drops by, let's say, 10% below the intrinsic value, I start to, I open the position, say I put in 2,000. And then if it happens to drop again by maybe another 5%, I put in another 4,000. And then even if it goes up again, I can then add another 3,000 and then another 2,000. At the end of the day, my average will I will do what is called discounted dollar cost average. My average would be pretty good at the end of the day. So this is to say there are different approaches to investing. Some people, they like to invest passively and not worry about the fluctuations in the market, and some people like to do active investing. In other words, they choose individual stocks. But it's very, very important that you invest in those businesses that you understand, and not just speculate because you can lose your money. So that's it for today. I thank you, and please don't forget to subscribe if you want to listen to more content like this in the future. Thank you.